Hi, everybody, and welcome to today's webinar, Fixed Income EMSs, The Time is Now. My name is Audrey Blater, and I am the head of Risk and Financial Markets Regulation at Coalition Greenwich, an independent research and consultancy firm. Before we get started, I want to go over just a couple of very brief housekeeping notes. This session will run approximately 45 minutes. If anybody has questions, I'll ask you to please drop them into the chat. We'll do our best to address them afterwards. If we do not, you can certainly reach out to us via email, or we'll see your question and we'll reach out to you. And then lastly, we'll be sending a copy of the recording in a few days, so you'll have access to that as well. Joining me today are a panel of experts who are prepared to discuss the ins and outs of execution management systems, or EMSs, as we like to call them. I'll ask them to take a brief moment to introduce themselves. So turning to you.
So Spencer Lee at TS Imagine is the Chief Markets Officer and Head of Fixed Income. And I think maybe a little more interesting is that that is only as of 9 months ago or 10 months ago or so. Prior to that, I was on the client side for 20 odd years as a trader, managing different trading desks, primarily in credit, but also rates, munis, and securitized and other products when I was running the desk at BlackRock on the West Coast. After BlackRock, I was at a startup hedge fund that some colleagues and I began, systematic credit called Agilon Capital. It was at that point that I was introduced to TS Imagine. I was, interestingly, I think their first fixed income EMS client. Which was nice for me because I got some things that I couldn't find elsewhere in the market. And being the first one, also had access to the dev queue for many years there, and worked with the team to develop much of which you'll see in our platform if you ever take a look. But all those years on the buy side has allowed me a unique perspective here.
Thank you, Audrey, for having me. Ken Adis from Bank of America. I manage all the electronic trading initiatives for credit for Bank of America, and I'm a e-credit trading strategist as well. Thanks.
Good morning. I'm Alex Bouzalis, Morgan Stanley Investment Management, Broad Markets Trading.
Great, thank you all for joining us. Jumping right in, one of the questions I think we wanted when we had our original discussion was to get this notion of what exactly an EMS is and what it's not and why it's important. So to start up that topic, recently Coalition Greenwich conducted a study of 41 buy-side firms with AUM in excess of 22 trillion to unearth trends in trading practices and technology. What was immediately clear in our findings was enthusiasm for EMSs, as you can see on the slide, where the majority of participants, at least that are using EMSs, feel that in some way, shape, or form, it gives them an edge while trading. However, only 39% of our participants were actually using what they considered to be an EMS. Looking more closely, what we found is if we use today's definition of an EMS, which is this notion, and we'll get into this, of a true multi-venue, multi-data source technology, that figure sank to only 12%. Our panelists are part of a relatively small group with hands-on EMS knowledge and have some great insights into how EMSs can really work in our bond markets. So perhaps turning to you first, Spencer, I think discussing what a built-for-purpose EMS really is would be a great place to start this discussion. And of course, Alex, I'd love to hear your buy-side perspective here as well.
Yeah, thanks, Audrey. Alex and I may bleed over into each other a little bit because, as I mentioned, most of my career has been on the buy side, but found so much utility out of the EMS as something distinctive from maybe the OMS world a little bit that is focused a little more on the portfolio management side. The EMS is really focused on the experience of the traders in the market. Traders, want to see access to data. They want access to the different venues at all the different protocols. That includes dealers, in that mix increasingly with direct dealer connectivity. So we're aggregating all of that data for pre-trade information and then giving the buy-side traders the ability to execute on that liquidity content back through the same pipes. And it's really important in my mind because up until now, this technology that is the EMS is changing things a little bit, but up until now, it's been a very serial engagement, unique, sort of discrete, like one trader has to go into a venue over here or a venue over here or a venue over here to do, basically their job, which is, pre-trade price discovery. It's been a difficult process, and we're streamlining that, and then also giving them the tools to execute on it when they decide what they want to do.
Alex, what are you thinking?
Yeah, so I wanna focus primarily on what Spencer mentioned. It's very much about the user experience for the trader. An EMS solution provides for a tailor-made workflow experience for the trader. And it does a lot of other things that, depending on each firm's focus in terms of types of engagement and/or asset classes, can really sort of enhance this engagement. From our perspective, we very much endeavor to make the trader's job easier, as Spencer mentioned. It's also a means to streamline what data we capture, and more importantly, how we use and display this data. The fact of the matter is you can use an EMS for capturing data, but in practicality, we actually use other means as well. And finally, as I said, there is it's a neat approach of trying to customize your engagement in different asset classes. We endeavor to use it in more than credit, and even in the case of credit, credit is a broad definition that potentially an EMS can really help. Finally, it is also a means to cultivate direct connectivity with the liquidity providers. Again, there's different ways you can do that, but somehow standardizing through an EMS solution might be somewhat appealing for the liquidity providers.
Those are all very interesting points. And I'm curious, maybe Ken, kicking this question over to you. Can you talk a little bit about what an EMS really means for dealers?
Yes, thank you. So, look, I think that from a dealer perspective, dealers want to be a part of all the channels and platforms that clients choose, right? However, before fully jumping in, I think that the dealer community often factors in a multitude of things, such as relationships, volumes, potential volumes, technology efforts, and ultimately we look for critical mass as it pertains, I think, to inquiry and volume, because as Spencer and Alex just mentioned, there's a multitude of ways for the buy side to use this, in terms of aggregating data and things they mentioned. However, from our standpoint, we only see it from primarily the direct and disclosed channel of inquiry and volumes getting done. But Audrey, some stats that stuck out to me in the report were that only 12% of the buy side are using what's considered a true EMS, and many on the buy side can't connect directly to their dealers. And right. I believe the two biggest factors mentioned in your report were the reasons they can't connect directly to their dealers is one, buy-side tech resources, and two, dealers are not offering direct connections, right? So from a dealer's perspective, I can speak a little to that. I think that, we're being asked as the dealer community to connect to a multitude of different channels on this topic, which include EMS, but also electronic trading order management systems, and having potentially a direct pipe with a specific client as well. Some clients are even asking us to do all three of these things with them specifically. So this becomes challenging because dealers may have internal responder platforms that need to integrate and connect to each channel. And then on top of that, speak to each of the different protocols. And there's a multitude of protocols involved here, right? So it's like, is it click to engage on an axe? Is it click to trade? Is it RFQ with negotiation, in comp, list, portfolio trading, solicited, unsolicited? So we have to figure all these things out. And then if it's investment grade, there's spotting concerns, like who provides the spot? Is there delayed spotting, hedging, and so forth? We have to wire and configure those workflows. Ultimately, we have to build, code, test, and QA all of this. And if an algo is involved, there can be some governance forums on top of that. And sometimes we're not provided a testing environment, which could slow things down in terms of quickly remediating issues. And then lastly, I'd say we have to train our traders, right? So it's a lot involved here. And I think that ultimately we have to prioritize the builds based on client demand. And what this turns into is a bit of chicken and egg as it pertains to client volumes and dealer adoption.
Yeah, I mean, there's a lot of engineering considerations that I'd imagine are happening versus, say, 5 years ago when necessity just wasn't there. If we go to the next slide, in our study, what we found was that the most utilized functions of an EMS are things like access to liquidity from multiple sources, and also having that liquidity in a single blotter. The automation aspect of the trading workflow was also mentioned as being really important. But what it seems to me is happening, and maybe you can comment a bit on this as well, is that, when you consider all those channels that you brought up and the need for more connections, this really becomes exponentially more difficult to achieve than, again, maybe 5 years ago where everybody was mostly just using an RFQ. What would you say the advantages are, today, if you can actually achieve these connections? What's happening that's different versus 5 years ago? And I'll open this up to everybody to answer.
Maybe I could jump in there a little bit. I mean, having been a client and for that 5-year period, that you mentioned, I mean, and seeing the evolution and kind of been, I think, one of the few folks out there that has been pushing, different stakeholders, in our marketplace to, maybe move forward and try different things. Ken hit on a lot of different sort of pain points from the dealer perspective. And I think from the buy side perspective, these same pain points exist, but it's also a little bit of not knowing what's possible. I think on the buy side, we've been, as buy-siders, and I put myself in there too, operating in this status quo period for, better part of 10 to 20 years. Now the EMS comes along, represents new technology that can do different things, can do more things and better things, in my opinion, and can respond to the dealer effort or the dealer need to do this direct connectivity. And importantly, in my opinion, normalize that engagement for the buy side. To make it easy to do click to trade, make it easy to do click to engage, make it easy to leave orders with a dealer directly should they want to do so. And these pipes are really just the building blocks to do a number of different things, with the dealer community. But I would also add that, first and foremost, like the venue community is an immense partner of EMSs like ourselves, because that's where most of the flow is right now. And I think it will continue to be a significant part of the marketplace. So the trading APIs that are now available with the venues are made available to clients. And as a third-party provider to a client, we can integrate with those, and we have integrated with those trading APIs and bring all of that functionality that's available in the GUI into that single blotter, so that clients can now do in-blotter RFQ launching to the multiple different venues of whatever they choose. They can do in-blotter click to trade, in-blotter click to engage. They can do in-blotter leave an order. They can do in-blotter all-to-all responding across multiple venues. One of the pain points while I'm on this topic that I think a lot of buy-siders will identify with is this need to update multiple watch lists across these venues in order to make sure that they are aware of opportunities. That sort of falls away. Not sort of, it does fall away. You know, when you're using a platform that's doing that, looking across all venues for you in the background simultaneously throughout the trading day, so you no longer miss an opportunity, which is, you know, I don't think there's a person on the call that sat in a trading seat that was looking, you know, hasn't been looking for a bond for a day or 2 days or a week, and then suddenly it hits trace and you're like, oh my gosh, where did that happen? Like, you know, now, you know, you've got a much better chance of being aware of that at the time. I myself as a user have had, you know, situations where in the middle of doing 2 or 3 different things, IOIs at a different venue that can do that, responding to an all-to-all opportunity, maybe seeing direct dealer liquidity and the full depth of stack in your EMS, and then boom, something new pops up from a different dealer on a different order. Alerts happen to give you the, you know, wake you up to the fact that you can click to trade on that right here, right now. I mean, I did $10 million blocks on, you know, click to trade, click to engage type of stuff with dealers, and it was quite nice because I think I beat everybody to it because my system woke me up to what was relevant for me.
Yeah, great points. I mean, I haven't traded in a while, and I remember those problems being very prevalent. You know, if we just switch over to the next slide, you can see that, you know, the protocols that have been used for quite some time are still being used. I know, Ken, you were talking about a number of different protocols and engineering challenges, but you know, in what way, you know, in the previous slide, obviously, we talked about automation being really important. Then we have all these trading protocols, and maybe Alex, you know, you can opine here too. How does an EMS actually help the trader automate between these different protocols? And then, you know, Ken, from your perspective, you mentioned about the engineering tasks that need to be done to make some of this happen and make it all come together. But I mean, you know, generally speaking, how does everybody deal with these numerous protocols? And you know, of course, Alex, I'm curious to hear what the advantages are for you.
Yeah, I could. Go ahead, Alex. Go ahead. I'll follow.
Thank you. Yeah, so I want to start by saying that the role of the existing platforms cannot be understated, right? So, and in fact, I consider them responsible for a lot of innovation and progress that took place in the market structure space in the years past. Having said that, I want to stress again the point that I made earlier, that an EMS comes to serve very explicit needs of each firm. So each user can consider exactly the types of engagement they want to address, and perhaps if they are broad enough and in some degree of scale, an EMS can really aid in that effort. So we want to, you know, we consider a lot of different types of engagements, and you know, as Ken was mentioning, there is scope to help on a bilateral types of engagements where things may be happening through a chat or through a phone, and provided sufficient connectivity and range of types of engagement available, you can perhaps do this through your EMS via direct connectivity. You can potentially address your interest to provide liquidity or respond to market inquiries. Of course, all platforms do that. All the platforms do that to some extent. But again, if you are trying to cover the whole spectrum of the marketplace, concentrating this in one sort of user interface and provided with a sufficient degree of automation built in the trader can do that a lot easier. Obviously, there's other things like portfolio trading potential and other things. But as I said, it depends on what each firm wants to focus. Finally, I think a lot of the interest for us, and I think for other market participants, is addressing further market structure development in asset classes where perhaps they don't have the progress we've seen in the IG and high yield space, namely the municipal market, EM market, portions of the EM market, and perhaps at some point even securitized or loans.
Interesting.
Yeah, the product expansion is a big one. I mean, it's, credit has, I think, led the way here a little bit with adoption of EMSs and rates behind that. We're seeing a ton of interest from our prospective client base and municipals as well. And that EM is not far behind. So the utility is starting to, I guess the understanding of the utility of the EMS is starting to seemingly spread across the marketplace. And where there's fragmentation, where there's a need for sharp pre-trade data, all of that can be captured in one spot and make the trader just a lot more knowledgeable when they're deciding which protocol to use or which dealer or liquidity provider to address. All of those concepts are applicable across a number of different fixed income products.
Yeah, I think it's interesting from the report that states, I think from a dealer perspective, as I mentioned earlier, our main objective is to get that direct dealer connectivity and trade workflow, right? But the report states that only 25% of the buy side deem direct dealer connectivity a reason to use an EMS. Obviously, conversely, I think we think otherwise. And the direct channel gives the ability and affords, from our perspective, a better way to match dealer access to client needs, right, and client demand. So if we can do that, I think that's a win. And in addition, that channel, looking at access and the matching, could possibly lead to larger size trades, which is where I think the market is looking to sort of further electronify. And then lastly, I'd say that a direct connectivity and trading opportunities could potentially lead to lower fee structures, right? The only issue I think that may arise for some dealers adversely on this is the fact that direct volumes take away from in-comp platform rankings, right? So, and I think rankings are interesting I would say from a dealer perspective, because, it depends on a dealer's view. First of all, internally, how important are rankings for the firm? Secondly, is how would potentially a dealer or bank portray their rankings to their clients? And lastly, I think more importantly, is how do clients use rankings for judging dealer performance? So these are all factors I think that come into play.
Yeah, I mean, this is a great time to pull up our next slide too, because we've kind of gone into this sort of direct dealer connection zip code. But I'm sorry, Spencer, you were saying?
No, I think that we're probably heading this way. I've got a little anecdote that I could share with folks on my direct dealer trading volumes and kind of what how that developed and what it represented and why I let it develop.
Yeah, that's great, because as you can see, and as Ken alluded to as well, there's a desire for direct connections, but when it comes down to who's actually doing it, you're talking about less than half of our participants who responded to this question. A few more on the EMS side, or what they're considering an EMS, than the OMS side. But certainly you have folks saying that they want to do it at some point. But curious what your thoughts are, Spencer.
Yeah, maybe before I go into my little anecdote, I mean, the direct connection game is not an easy one. As Ken was pointing out, I mean, there's a lot to consider. both on the dealer side and the buy side, as Alex was pointing out. I think the EMS is what I've found to be, in my experience, the most well-suited sort of entity or tech vendor to be the facilitator of that connectivity. They've got the most experience doing it. They've done it in other marketplaces. It sounds new to us in fixed income, but to be honest, it's been done before. The existing tech stack, I think, that all of us have been used to in the fixed income world is not really well suited for that. I mean, they have a hard time generally with real-time price ingestion. The deployment and sort of the new innovative things kind of takes a long time. The EMSs have this right off the shelf. And they're also quite used to doing the deep integration work necessary to bring to life all the details and nuances of the protocols. So Ken hit on a bunch, and all of these are available right now and what I've used as a client at TS, and we continue to develop that each and every month here with expansion of our dev team. And we've nearly tripled that to lean into this fixed income EMS opportunity. But it's one thing to say connected and be able to stage orders into another venue. It's quite another thing and quite a new thing to say, I'm connected in a way that I can now take that functionality that exists in all these other places and bring it into a single blotter so that I don't have to go, into these discrete applications all the time. And from one blotter, I can look across the entire landscape and have the choices that I think a trader needs to see. And then they can figure out which one's the best approach for that moment on that particular bond. I mean, in IG land, spread, deferred spots, do you want to cross treasuries? I mean, all of that is possible off the shelf in TS EMS. And I think for a proper EMS, that's what should be available. So we've done that work. And if dealers want to code up, to us, it's all available. And the same thing for clients, obviously they'd be the beneficiary of that. The anecdote that I had regarding, direct dealer connectivity, and I know it's been a hot topic for a few different years now, is that in my trading volume before coming to TS, obviously it started at zero. There were very few dealers, connected in the early stages. I started this 2 years ago, actually over 2 years ago now that I've been here for 9 or 10 months. And little by little, another dealer came on and then another dealer came on. But it grew to be about 10% of my monthly trading volume. And of that 10%, about 20 of it was click to trade on dealer algos, but 80% of it was click to engage. And that is a different content, and it's coming from the sector-based traders. So this is what we're used to seeing as buy-siders through IBs and telephone calls and emails and Bloomberg messages and such. So all of that was being streamed in and parsed and instantly recognized by the system and gave me a clickable, action. And, the reason why I let it grow is because it became the cheapest protocol on a transaction cost basis of all the other protocols. And it was kind of mind-boggling at first because we're doing nothing but electronifying a voice trade, and voice has always been the most expensive. But what was happening, I think, were a couple of different things. Is when I sent that inquiry back through the pipe that it was delivered, the trader on the sell side really appreciated that non-comp inquiry on the acts that they'd sent out. They were more likely to stand up to the level. My system was always waking me up to this opportunity, saying it's the best. And so when it's the best, there's a little bit of selection bias. And then I think over time, as we're educating ourselves in the marketplace, myself included, and then the sell side traders that Ken mentioned earlier, I mean, they grew more confident that what they were disseminating through these pipes was going to the people that they intended it to go to. They had a much higher degree of confidence that the audience that they were trying to reach was getting it, and then made relevant for when it suited them. And then the pathway to execute was completely clean. So I think that when the sell side traders develop this confidence, they'll put sharper prices, they'll put larger sizes, and it just kind of feeds on itself. And I think during that time where I was learning about this direct dealer connectivity, I was the beneficiary of that effort and had better prices, and it quarter after quarter for 2 years was the cheapest transaction cost protocol of all of them, and that includes liquidity responding, or excuse me, all-to-all responding, liquidity providing.
Yeah, I mean, kind of this is a good opportunity, and Alex, I would love your opinion here as well. Getting into that topic of buy-side liquidity provision. If you look at our next slide, There is a bit of a debate as to whether a broader view of the market will encourage more buy-side traders to provide liquidity in fixed income markets. So you can see on this chart that, well, we have about 77% of our study participants claiming today that they're doing it or want to. There's still a question of how much of it is actually being done, right? Like, does it happen once a week? We don't know from this data. And we don't know how it'll overall impact liquidity. So Alex, I'm just curious, in your opinion, and what you're thinking is here, do you believe an EMS makes it easier for the buy side to provide liquidity to the market? You know, again, considering they may or may not be doing it with an EMS, and what's the market benefit to this?
Yeah, so I will answer your question directly in a second. I just want to go back to some of the stuff that Spencer was saying before, because I feel it's important to highlight from our perspective. So I cannot stress enough the fact that, you know, an EMS provides for a lot of customization, but requires a great deal of investment from the user's side in actually customizing it and setting it up, and essentially provide this ongoing dynamic evolution in order to harness some of the potential benefits that you can have. So I offer that as a disclaimer, that because, you know, at least from our experience, notwithstanding the functionality that a lot of these solutions provide, it is upon the user to really spend the time and the effort and put the commitment to essentially develop it at a level where the users can really benefit. So that is very important, because it really goes to clearly defining what exactly a user is trying to get at. And I mean, in terms of scale, in terms of what markets, in terms of what types of engagements, benchmark this, create the resources to support this dynamic development, ongoing dynamic development, and especially, you know, make a judgment call of where this development needs going to be, you know, in the medium term, because it takes all of these things for at least for, I'm speaking for myself, it takes all of these things to be in place for you to embark on this journey. Now, to your question about liquidity provision, yes, users such as ourselves are very interested to provide liquidity. We actually do that on an ongoing basis in some form, and perhaps most interestingly, often it happens in a very sort of bilateral form, as well as, you know, responding to anonymous RFQs and so forth. You could argue that an EMS with sufficient direct connectivity between the relevant liquidity providers or counterparties can enhance this sort of bilateral angle. That's one way to think about it. The other way is some of the things that Spencer mentioned, where an EMS can endeavor to streamline the ability of a firm to be aware of different RFQs out there in securities that they have cares, and streamline the ability of a desk or a trader to respond holistically across venues.
Yeah, I mean,
I would add a little bit that, you know, look, I'm a bit of a fanboy here for an EMS. I mean, I was a user for a long time, and now I voted with my feet because I believed in it so much. But it really just becomes a bit of an afterthought about how easy it is to respond to all opportunities when you use an EMS. I mean, I've lived that life where I had to manually update watch lists in different venues in order to get the proper alerts. So now, like, your blotter becomes the watch list. Your watch list in one spot is the watch list for every venue. So that liquidity information or those opportunities are flowing in. And look, it's pretty simple. It's a cross-referencing exercise. That liquidity is matched up versus your cares and your system, your buy-sider safe space, as I like to call it. So no longer are you having to push all your information, to other venues. And look, it's all protected, I know, but it's maybe just a step better if you don't have to send it places. And then as soon as that opportunity is identified, because the system is doing that behind the scenes, regardless if it's RFQ venue 1, 2, or 3, or 4, you become agnostic to it. And it just has a button right there that says respond. And then you go in, you put your level, and off it goes. And then you're off to doing the next thing. And then if you trade that bond, then it's no longer on the watch list. You don't have to go update it in multiple places. And so it's going to make, in my opinion, liquidity provision a very normal part of the buy-sider's trading life and a very easy thing to do.
Yeah, I mean, if we pull up our next slide, and Ken, you may have an opinion here on how things may change or situations may change, or what you're seeing when an EMS comes into play. I mean, there's still a ton of reasons for picking up the phone and calling your counterparty. There's less liquid names being the most common reason, block trades, as was discussed before. Maybe there's just insights or market intelligence that your client wants. How does an EMS kind of change this, or does it? Does it need to?
Yeah, there's always this debate about, what the saturation point is in terms of the electronification of the credit market, right? The Coalition Greenwich report states that 40% of IG and 31% of high yield is, corporate credit volume is electronic. Now, I've seen Coalition Greenwich reports state that the European percentage is actually higher, and that's around 50–60%. And it's interesting to note that the European electronification levels have plateaued out for some considerable time. So I think that potentially there could be a saturation point there, and the U.S. may eventually sort of get to that 50–60% European level and plateau out as well. We don't know. It remains to be seen. But what we do know is that electronification of trading thrives on smaller size trades, greater participation, and for the most part, centralized liquidity points. I say that credit is less prone to electronic trading compared to, say, the equity market, because credit, right, by definition, is sort of the opposite of the equity market in that it's more fractured, right? So that's the first point. So what does that mean? That means that, as an example, say, for instance, there's one Ford equity, right, security, whereas Ford has a multitude of different credit CUSIPs. So you may be long Ford, I might be short, but we can't trade because it's not the same exact CUSIP from a corporate bond perspective. It's also less liquid. The average trade count of the top 100 most traded IG CUSIPs is 85. And it's only 30 for high yield. And credit, right, corporate bonds meaning, trades in much larger size. So it's like there's less participation levels because of that impediment. It's mostly an institutional market. Additionally, I would say that micro lots, odd lots, and now the most liquid round lots trade pretty well electronically in the corporate bond market. As I think you alluded to, Audrey, earlier, the problem in terms of furthering the electronification in the corporate credit market is the less liquid and larger size trade, right? And those types of trade need, I would say, or look towards dealers to use a lot of discretion to get those done. Which a direct dealer call provides. And to that point, it's interesting on the block part of it, only 2% of trades by count are block trades. However, there's roughly, 38% of trace volume. So an interesting dichotomy there. But in any case, we've seen platforms and various protocols such as dark pool matching try to solve for this conundrum of the less liquid and larger size trades from an electronic standpoint to what I would say is minimal, not to say no avail, but it's helped, I'd say, around the edges, but it hasn't solved for it. But I think this alludes more towards the unique market structure of the credit bond market more than anything else.
So if we can believe it, there's only about 3 minutes left. I'm going to pull up one final slide that I hope we can discuss. And this kind of deals with this sort of now of the tech stack that our study respondents mentioned. So you can see, for instance, there are some current capabilities that are EMS-like, even though few are actually using fit-for-purpose EMSs. Things like 80% of our respondents indicated that they automated parts of the execution workflow, that they do have access to some pre-trade price transparency, and they're executing portfolio trades without a spreadsheet, those types of things. But, curious that, if this is the now state, how really do we get to the state where the more progressive adopters of EMSs are living? What needs to happen to sort of change some of maybe the things on the bottom part of that chart, like consolidating, execution capabilities across venues, or being able to record best X, maybe in real time, or post-trade TCA. Aside from just saying, hey, go get an EMS, I mean, where should the thinking be? And again, I'd love to hear everybody's thoughts, because we have a couple of minutes left, on EMSs and what you'd like to leave the audience with.
Maybe I could jump in there and try to tackle a few of those super quickly if I can. I mean, on the automation, bit, I probably failed to mention when we were talking about liquidity provision, like in our tool, you can automate the responding to all the all-to-all opportunities. It's one of the more popular features of our current client set at the moment. So you can set your own criteria. It's actually a long laundry list of items that you can use to qualify the opportunity and how you want to respond, using price sources of your choice and shading and risk reducing, risk increasing. I mean, there's a number of different things you can do. That's just like one of the first steps, I think, in this automation journey that's going to happen. I'm aware of the automation tools out there. I've used them myself. They're very kind of venue or location specific. Again, the EMS aggregates all of that and automates it at a higher level to, I think, create even more efficiency and cost savings than what's available on this sort of discrete basis. We have all of this liquidity that's flowing into the system and to a proper EMS, in my opinion. All of that should be made aggressible in an automated fashion. So we have auto responders right now. We have auto routers. We have auto execution capability. We're currently working on ways to kind of put that into a bigger book of automation and almost create like a smart protocol chooser, if you will, to look across all these venues and kind of be in liquidity taking mode and then switch to liquidity providing mode. It's almost like a buy-side algo, so to speak. So that'll be a neat, transition, I think, that will be allowed through the use of this advanced technology that exists in the EMSs. You mentioned TCA. One of the challenges that I think we've not yet mentioned with this direct dealer connectivity and this bilateral execution is capturing the best X sort of support for making that choice. Now it's easier than ever. I mean, look, we've all been doing it, when we do voice trades, so it's old hat, but it's very manual. But now when you execute through a direct dealer pipe or any other manner on liquidity that you see in an EMS, you can snapshot the market at that very moment. And so that provides like the competitive quotes, if you will, that you would get in an RFQ, and gives you the confidence to be able to use that protocol whenever you choose, knowing that you're going to have that evidentiary support, whether it be at the time of the spread execution or at the time of spot, later on. And that's available in Blotter at the time of trade, and then of course, post trading day for analysis, and best ex meetings and trade surveillance purposes. In fact, all of the data that flows into an EMS, both execution-wise and liquidity-wise, is made available for our clients. Look, we don't commercialize this. We think it's client data and we think it's liquidity provider data. We're just purveyors. I believe very strongly in that as a former buy-sider, but they should have access to it. And with that access, they can do any number of different, either surveillance tasks or, quantitative research, efforts as well.
Curious, Alex, Ken, final thoughts?
Yeah, for me, again, as I said, everybody has to choose what's important to them. Obviously, each firm has their own priorities. I can see some benefits in enhancing or streamlining bilateral engagement, provided there is ample connectivity and ample types of protocols offered. I agree that some of the things that are very low, whether it's DCA, is probably low, and I don't see that is the best way to address. And overall, I mean, it's a matter of scale. So scale across asset classes. It's an effective way to enhance desk productivity and desk efficiency ultimately.
Thank you for that. And Ken, any final words?
Yeah, look, listen, I think we've covered a lot here. And what I'd say is that there's no magic bullet here that solves every problem, right? And I look to all these different solutions as whether you're on the buy side or on the sell side of having, I play golf, so the way I see it is like you have a golf bag and you have different clubs that do different things, right? So you're not going to pull the same club to use on every shot, right? You're going to use it's situational. So the nice thing is there's a multitude of different protocols. We want to make this more efficient. We want to save time. We want to lower fees for everybody, and have the right tools at our disposal to be as productive as possible. So
that's really great. I just want to thank everybody for your time and really wonderful insights that I'm sure our audience took a lot from and enjoyed listening to. Just a quick reminder, the slides are available via the GoToWebinar handouts module. If anybody wants one, we will also be sending out the recording in a few days. And thank you, everybody. This is a great discussion.
Thanks, Audrey.
Okay. Thank you. Pleasure.